Okay, we're going to look at gross margin. The formula for gross margin is gross profit divided by revenue. It's one of our primary profitability ratios. And of course, we can recall that gross profit is simply revenue minus cost of goods sold. So we can express gross margin as revenue less cost of goods sold, all divided by revenue. An analysis of gross margin can help us answer two fundamental questions about any company. First, how efficient is the company at producing product for sale? And two, is production getting more or less efficient over time? So let's look at an example using Hasbro. This is the 2018 year-end income statement that you can find in Hasbro's annual report or the 10-K that the company filed with the SEC. The first thing that we'll notice is that in their presentation of the income statement, gross margin is nowhere to be found. But that doesn't bother us because we know how to find it and all the pieces are actually available. For gross margin, of course, we only need two numbers, revenue and cost of goods sold, and sure enough, these values are both given. So for Hasbro, we'll take $4.5979 billion of net revenue. We'll subtract $1.85 billion of cost of sales, and that's our numerator. In the denominator, we repeat net revenues, $4.579 billion, and we divide one by the other, and we get a gross margin of 59.6. So this means that it costs Hasbro about 40 cents of it on the dollar to make toys that they sell to Walmart, and they have the rest, or 59.6 cents of every dollar to pay for the other expenses, and hopefully they have some profit left over at the end. So is 59.6 good or bad? As analysts, how do we evaluate this? Now that we know that Hasbro's gross margin is 59%, what can we say about the company? Well, one way that we can think about this is that we can evaluate the question, are they efficient at producing product for sale? And we can answer that by comparing Hasbro to similar companies who make similar products and sell them to the same customers. So in this case, we can compare Hasbro's 59% of gross margin to Lego, Spin Master, and Mattel, three other large toy companies. And we can see that Hasbro is at the upper end of the range of the peer companies. At almost 60%, Hasbro's gross margin is less than Lego's, but more than both Spin Master and Mattel's. And when we compare Hasbro's gross margin of 59% in 2018 to the same measure in prior years, we can see that it's been worsening over time. In 2016, it was 62%. It dropped by 1 percentage point in 2017, and then again in 2018. And using both of these comparisons together, we can see that while Hasbro's gross margin is still better than some of their peers, it is worsening over time. In addition, we know that their sales are declining. So worsening gross margins and declining sales could be a cause for concern and would prompt us to want to ask management about this situation and what their plans are to turn it around.